Welcome, everyone, to the Nichols Weekly Tax Update podcast. As we were preparing to record interesting items from last week, a significant development broke again. The second COVID-19 relief legislation passed both houses of Congress and headed for the president's desk for signature. Then, the president refused to sign it. Still, while we don't know the amounts of relief, we believe that amounts paid with PPP loan proceeds will be deductible or increased basis even though the loan is not required to be repaid. We also believe that foreclosures and evictions will continue to be under forbearance rules. So watch this space for a COVID-19 relief special podcast when we know more about what's going to happen. This program is produced to provide current information about developments in United States tax law, such as it is. Cases, rulings, IRS pronouncement, expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I acknowledge the value of my subscription to Tax Notes Today, the preeminent source of current development information for tax professionals in my preparation of this program. So, having given proper credit to Tax Analyst's publication of Tax Notes Today, let's continue. What's in this edition? Partnership liability allocations. The best information you can get directly from the IRS in an IRS practice unit. Then, what are partnership liabilities anyway? Defined in another IRS practice unit. Why these two practice units? Because of the new emphasis on partners' negative tax capital and the requirement that we report the partner's tax capital in a tax return and on the Form K-1 each year. Then, our third item this week, tax extenders. In the Taxpayer Certainty and Disaster Relief Act of 2020, a summary, an account of topics. No way we have time to go through all the details. Then, Tax Cuts and Jobs Act income accounting rules. Final regulations, an advance copy, over 100 pages, of the final regulations on the tax accounting rules that require us to recognize income at a particular point in time. Then, from something unbelievably complex to something unbelievably simple, the 2021 standard mileage rates, with a twist that you may not have ever paid much attention to, but I think really becomes important sometimes. And finally, coming attractions. COVID-19 related Tax Relief Act of 2020, as soon as we know what's going to be in it. Okay. Partnership liability allocations. Practice Unit PARC 004, emphasizing the impact of those allocations on the computation of a partner's basis in their partnership interest. That opens with not all liabilities shown on a partnership tax return balance sheet, that's the Form 1065 Schedule L, are recognized as liabilities for tax purposes. Well, wait a minute. If you don't recognize them, why do I got to put them on the form? I suppose you're going to tell me that, right? An 18-page PDF copy of a PowerPoint slideshow. Absolutely suitable for staff training, and it's free. You can download it. You can convert the PDF document using an Adobe program. You can convert the PDF document to a PowerPoint slideshow and use it for lunch and learn on any Friday or Monday, whenever you do staff training, for internal staff training, which everyone is going to need to know more than we know already about how to calculate partnership liabilities in order to determine a partnership's tax basis. Next, on the same note, or in the same staff, but on a different note, practice unit on the definition of liabilities for federal income tax purposes in the context of partnerships, addressing both recourse and non-recourse liabilities for the purpose of assisting in the calculation of a partner's basis in a partnership. Why? Because we have to report it now every year as part of the partnership tax return. This is a 24-page PDF copy of a PowerPoint slideshow, which is just as suitable for staff training as the other. The two of these are a wonderful diptych. That's something has two parts. Diptych, that's a fancy word I learned just last week. It's a wonderful two-part program for training staff in recognizing and allocating partnership liabilities that are treated as liabilities for income tax purposes. Okay, next. Tax extensions in the year-end legislation. The Taxpayer Certainty and Disaster Relief Act of 2020, which is a bit of an oxymoron, as though there was ever a taxpayer certainty about anything. 10 provisions are made permanent, 12 are extended through 2025, 19 are extended through 2021. Now, mind you, last year, all of those were extended for 1 year. So the lobbyists have been at work. 10 of them have been made permanent to encourage investment. 19 have been extended through 2021, the same old 1 year renewal. 12 are extended through 2025, given 4 years to enjoy the benefits of whatever and do some more lobbying. And 19 are only extended through 2021. We're going to go through the dance next year on those. 14 miscellaneous provisions have various effective dates, and they're not all about Disaster Relief Act. They are about taxpayer certainty. One in particular, I noticed, had an extended date of 2022, not 2021, not 2025, but 2022, just to keep us on our toes, I guess, and make sure that you recognize the period of extension. Then there are 6 actual disaster relief provisions for those of you that are following that, and for those of you who have clients who have been the victims of a natural disaster, a presidentially declared natural disaster, and we've certainly had more than our share of those in 2020. Final regulations on the Tax Cuts and Jobs Act accrual method rules. What a dust-up this has been. The tax people decided that we would have to pay tax on income that we recognized in our financial statements. What a novel idea. We were telling the bankers one thing and telling the tax people something else. We were telling the SEC and the public one thing and telling the guys at the IRS and the gals at the IRS something else. So if you work for the IRS and you read the Wall Street Journal and you see the earnings reported, then the next week you're detailed to audit the tax return of some public company, and you see this great difference, you have to naturally wonder, what is going on? Why does the world work this way? Why do we let public companies tell the public one thing and tell us something else? Income is income, right? And that's what the Tax Cuts and Jobs Act undertook to do. These final regulations on when income must be included for tax purposes under an accrual method of accounting, including the treatment of advance payments for goods, services, and a few other items, as those are required by the Tax Cuts and Jobs Act. Not an accounting rule, nothing the AICPA had anything to do with, nothing the audit board had anything to do with, but here is the Internal Revenue Service telling us how, oh no, they're not telling us how to calculate income. They're telling us that when we recognize income for financial statement purposes, then we must recognize that income for income tax purposes. That's all. Why is it so complicated? Why does it take over 100 pages of regulations? Well, among other things, they wanted to be sure we all understood what an applicable financial statement was, and then they wanted to make sure we understood that if you are now required to change your accounting method because you weren't properly reporting your income before, you were telling the banker one thing, telling the IRS something else, now you got to tell the same story to everybody. You're going to have to change your accounting method for income tax purposes. That means you got to fill out a Form 3115. Some of us have practiced for years and never had to fill out a Form 3115 or help a client do so. Now it's possible that for your largest and most complex clients, those that are the most valuable, your advice about how to complete the Form 3115 is going to be most earnestly sought. It's not simple. The regs run to over 100 pages, but you should recognize any client that has exposure here and you should prepare yourself to render good advice. Next, the 2021 standard mileage rates. I love this part. Every year, we get to tell you what the mileage rate is. For business use of an automobile, it's 56 cents a mile, and that includes everything. For charitable use of the automobile, it's only 14 cents a mile, and for medical or moving expenses, it's 16 cents. That takes care of the obvious. What's not so obvious is the requirement that we have an as-if, we have a deemed depreciation deduction. The taxpayer who uses the 56 cents a mile deduction in 2021 must treat 26 cents of that as depreciation. Now, we're not filling out a depreciation schedule, mind you, but we're going to track the depreciation claimed at 26 cents per mile. And if you check section 4.04 of Revenue Procedure 2019-46, it'll tell you exactly how this works. It is necessary when you're disposing of an automobile in a taxable transaction that you know how much depreciation has been claimed in order to know how much ordinary income recapture there may be on the disposition of this automobile. Oh, that. Well, what are taxable transactions? Look it up. You might be surprised. Finally this week, COVID-19 tax soon, coming soon, watch for it. The effective date for many provisions is going to be tied to the CARES Act. Here's what we know, okay? The effective date for many provisions will be tied to the CARES Act effective date. A second recovery rebate will be based on information in your 2019 individual income tax return, but no repayment of an excess amount will be required. But the total amount is uncertain at 12/25/2020. It's Christmas. We don't know whether it's $600 or $800 or $2,000 or some number in between. A Social Security number will be required. No Social Security number, no money. The payroll protection plan and other loans will not be required to be repaid. The borrower's tax basis will not be reduced for any forgiven loan, and expenses paid with the borrowed funds will be deductible unless there is a totally unexpected change in the negotiation and in the philosophy on both sides. The Treasury's already rolled over on that issue of deductibility. Information reporting of forgiven amounts will not be required because that would only be confusing. There's no reason to report income from a forgiven loan when you didn't report the loan in the first place. Other generally favorable taxpayer conditions are included. We just don't know exactly what they are yet. That's it for this week, gang. I thank you for your support and for your following this program every week, and remind you, please stay safe. We need every one of you, and it's going to be an exciting and a challenging tax season coming up. I don't know that I'll even be able to meet with any of my clients face to face. And how can I really question them in a Zoom room? Something to think about. Bye. I love this every week.